I'm sorry, you guys. I'm crazy, aren't I? All right, loan programs. Lenders can offer a diverse choice of mortgage loan programs and financing options to meet the varied needs of borrowers. So all the borrowers are all different and they all have different wants and needs. And you have to think about what's best for your client. So it's your job to figure out, are they buying this house to have for 30 years? And I should get them the lowest interest rate and they should pay the most points they can to get the lowest rate for the life of the loan? Or are they going to sell this thing in 3 to 5 years and they should probably get a hybrid ARM with a lower interest rate and maybe interest only payments because the house is going to appreciate and then they'll actually have equity without even having to pay it down. So you always have to figure out what's the wants and needs of your client. Loan programs are generally classified as conventional or government agency guaranteed insured. Conventional loans can be further classified as conforming or non-conforming. So if it's conforming, this is how I remember it. If it's conforming, it conforms to Fannie Mae and Freddie Mac guidelines. Conventional financing terms when real estate is paid for or financed with a conventional loan, which is not a loan that's insured by the government, like FHA, VA, or USDA. So FHA and VA are more popular than USDA. USDA is for people who have like zero money, they're like people who barely can qualify out in the middle of the boonies. And these loans are 100% financing. So USDA, if you're in an area where there's not a lot of population, that thing's the best thing since sliced cheese. Most conventional loans today are purchased by government-sponsored enterprises. They're called GSEs. And GSEs are on the secondary market and they conform or meet the guidelines of Fannie Mae and Freddie Mac. So the two lenders on the secondary market that are the most popular is Fannie Mae and Freddie Mac. And although conventional mortgage loans are not limited to any specific guidelines, most conventional loans are. Highlight, fully amortized. So a fully amortizing loan means that you're going to start paying it in the beginning, and by the time you pay the last payment, it's all completely paid off. No balloon payments, no negative amortization, just you're making your payment. At the end of 30 years, the house is paid off. That's fully amortizing. They also call it, it's not in this book, but it's in the 20-hour book. They also call that self-liquidating. So if you want to write self-liquidating, I'll give you a second to write that. So it's liquidated by the end of the loan. And see, I always have one student in my classroom. That way, while she's writing, I know how long it takes to write. Okay, fixed rate loans. So fixed rate loans are loans that are fixed. Not necessarily, the payment may not stay the fixed the whole time because maybe they'll analyze your escrow account and find out they have to raise your payment to compensate for the escrow account. But they're fixed for the principal and interest for the life of the loan if it's a fixed rate loan. Long-term loans are usually a maximum of highlight 30 years. The Secure and Fair Enforcement of Mortgage Licensing Act, the SAFE Act, defines a highlight non-traditional loan as any loan other than, you might want to circle that, non-traditional is anything other than a 30-year fixed rate, fully amortizing loan. Therefore, a traditional loan is a 30-year fixed rate loan that kind of everybody is pretty informed of. However, you also have a 15-year fixed rate loan. So most people know that there's 30-year and 15-year, but most people don't realize that Fannie Mae and Freddie Mac, I can't talk tonight. Fannie Mae and Freddie Mac will do anywhere from 8 years to 30 years. So sometimes you may get a client that says, I've been paying on my loan for like 5 years and I really don't want to do a 30-year again. And doing a 20-year, my payment might be higher. Is there anything that I can do? And yeah, you can get a 25-year loan. However, most wholesale lenders like to, when they're selling their loans on the secondary market, they like to sell them in bulk. So they'll say, these are all 15-year, these are all 20-year, and these are all 30-year. So sometimes it's kind of hard to find something in between those, but they are available. Now, and the one thing is, you have to make sure that you're doing what's best for your client, because you have to realize if they've only been paying on their loan for 2 or 3 years, and you're not bringing them way down, it might not be worth it for them because right now they've already paid a bunch of interest. So in the beginning of the loan, you pay mostly interest. And then about halfway down, you start paying mostly principal. So if somebody's at the end of their loan and they're like, well, I want a lower interest rate. Well, you've already paid all your interest. By starting all over again, now you're gonna pay some more interest. I know you hate to tell people they can't refinance or they shouldn't, but you gotta be honest with them. Anyway, so there is the 15-year and the 30-year, and it says, let's see if anything's good there. The 15-year mortgage, because it's a shorter term. So on a 15-year mortgage, you're gonna pay about half as much interest than on a 30-year. but the payment is going to be almost twice as much, okay? So down to conforming loans at the bottom of page 68. As already mentioned, conforming loans are written to the guidelines of the GSE, so they're following Fannie Mae and Freddie Mac guidelines so that they can be sold on the secondary market. So there's 2 times when I say the word secondary, and you have to know the difference. Secondary market is on the back side where the wholesale lenders sell their loans, okay? And when they're on the back side, basically what could happen is your client's loan could be sold from one servicer to another servicer, okay? But on the front side, there's a thing called secondary, and that's secondary financing. That's where you're getting a second loan at the same time you're getting a first loan, or even maybe where you're getting an equity line of credit, which is in second position. So anytime it's a loan that's after first position, it's a secondary financing, okay? All with me? So on conforming loans with Fannie Mae and Freddie Mac, they like to see 28 over 36. So 28 is your housing expense ratio, and 36% is your debt to income ratio. So you want to highlight those numbers because you have to know 28 over 36 is the guidelines. So for purposes of testing, you need to know those numbers. But in the real world, far away and few and far away, I don't think I've ever done a 28 over 36. I know a long time ago I did like a 21 over a 23. But most of the time, your front end is going to be about a 34, a 36, or a 38, and your back end needs to stay below 45. But remember, for purpose of testing, 28 over 36. The best way I guess you could remember that is I was really much happier when I was 28, because when I became 36, there was much more responsibility. I don't know, just a thought. I always try to figure out ways to remember stuff easy. Anyway, the borrower must typically qualify for both. So when you're doing the test, if they qualify under the back end, but they have like a 29% front end, they don't qualify on the test. In the real world, they'd pass right through, okay? So make sure under both they qualify. Next page, top of 69. It says, Fannie Mae and Freddie Mac have standardized products for mortgage loans that they purchase that don't meet the SAFE Act definition of a traditional loan. The following are some types of loans that Fannie Mae and Freddie Mac purchase on the secondary market. The standard 30-year fixed or 15-year fixed rate loan, and that goes up to highlight 95% for the most of it, but 97% would be loans that are certain restrictions, okay? So they do go up to 97%. Adjustable rate mortgages with terms from 8 to 30 years, they go up to 90% loan to value. Home ready and home possible. They offer highlight relaxed guidelines, require home buyers to do highlight home buyer education, and require the borrower to meet annual income limits. So that's a big thing, that home ready and home possible have income limitations, okay? Homeowners education and income limits. Home style renovation and renovation mortgage loans that combine the purchase price and renovation costs. Isn't that cool? You can buy it for the purchase price plus the renovation cost into one mortgage with flexible qualifying. These loans offer no appraisal, no MI, and only 5% down, but these are Freddie Mac renovation mortgages are only available in certain areas. High loan to value refinances. Okay, the high loan to value refinances was a program, it was called HARP, H-A-R-P. And what HARP was at the time when people's homes were either worth what they owed, so they owed $450,000 and the house was only worth $450,000, or they may have owed more than the house was worth, but they had a high interest rate. So HARP made it possible for them to refinance and get a lower interest rate, okay? But those ended in December of 2019. It might have been 2018. Construction to permanent mortgage loans that combine a construction loan with a permanent long-term financing in one single transaction. So basically what happened was back in the day, and still a lot of people who build homes, they build a home and they get a construction loan. And at the end of the construction loan, guess what? They got to refinance and get their takeout loan. It's called a takeout loan. So it was really funny, so that you guys remember it. This is a really good way to remember it. I was working at the second mortgage company I was working at, and it was a great company. And I was sitting there, and they advertise on the radio, so the telephones would ring. So I got the call, and the guy's like really nice, and he's like, "So do you guys do takeout loans?" I go, "I don't know. What's a takeout loan?" And he goes, "Well, I built my house, so I got a construction loan. My house is all done, and now I need a loan to pay off the construction loan." And I go, "Okay, that sounds like it's just a simple refinance." And that's what it was. The only difference between a takeout loan and a simple refinance is you have to have the final permit signed off, which is the occupancy certificate. So once you have that, you can do the loan. But what happened was people who were building homes went, it's kind of not very fair because we're getting this construction loan and then we got to get another loan. So we have to get two loans no matter what. There should be a product out there where we can get a construction loan that rolls into permanent financing. And that's where Fannie Mae and Freddie Mac's construction to permanent financing loan came from, is the contractors just got, they all kind of raised a ruckus so that they wouldn't have to do that all the time. How about that? Next section. And we're on non-conforming loans. So conventional non-conforming loans do not meet the standards necessary to be sold to Fannie Mae and Freddie Mac. Lenders making non-conforming loans will have relationships with investors and other entities which purchase non-conforming loan based on their criteria. Lenders also have the option of keeping the loans in their portfolio. So sometimes loans that cannot be sold to Fannie Mae and Freddie Mac, like let's say you have a portfolio lender. So portfolio means they're keeping it in their own bank. They're going to collect the servicing on it. Okay. So the portfolio lender is making loans, and you might work for a portfolio banker sometime, and they'll be able to make loans that might not be able to sell to Fannie Mae or Freddie Mac right this second. So Fannie Mae and Freddie Mac will not take a loan that has one 30-day late in the last 12 months. Well, let's say that you have that loan and everything else is perfect about it, and it only has one 30-day late and it's 10 months old. Well, if you're working at a portfolio lender, they can make that loan, service it for 2 months, and then sell it to Fannie Mae. And they can maybe possibly even get a better price for it because it's more like a loan that they had to wait for. Does that make sense? Okay. Hope you're learning, guys, a bunch of stuff from me. I have it all in my head. So I'm looking at the book going, okay, what's next? So portfolio loans. So the reason it might be a portfolio loan, it says lenders also have the option of keeping the loan in their portfolio. Mostly banks and savings and loans, and may have within the limit of the law, deviate from the standards set forth by the secondary market players. There's two main reasons that it would be a non-conforming loan. Number one, highlight the size of the loan. If it's the size of the loan, it might be because it's too big. It exceeds Fannie Mae and Freddie Mac guidelines. So it's called a jumbo loan. So it exceeds the loan limit. You guys, the loan limits are going up really high in January. And for those of you who work at a company that uses UWM, I seem to push UWM a lot, but that's because they're so easy to work with and they don't compete with us. They help us. So UWM is actually now taking the loans with the higher limit, even though the higher limit is not going to be able to be sold to Fannie Mae and Freddie Mac until after January. So I think it's going up to like 922 for the high balance conforming loans. Right now we're down at like 855, 860, I don't know. It's not on the top of my head. I'm in CRAM course mode, okay? If I was in understanding the mortgage process mode, because that's the other class we do, I'd be telling you all the loan limits and stuff. So two reasons why it's not conforming. Number one, the size of the loan, so it's a jumbo not conforming. And number two, the quality of their credit. So maybe the borrower has bad credit. So here goes. Similar to getting graded in school, mortgage lenders will grade applicants for their mortgage loan. Borrowers that meet the minimum credit, income, and asset standards to qualify for the loan are called A borrowers, since Fannie Mae and Freddie Mac generally have most conservative underwriting. Their guidelines must be set to industry standards. A borrower who does not meet the minimum standards established by Fannie Mae and Freddie Mac are classified as a B or C borrower. This may be somebody who has a credit problem in the past, such as a bankruptcy. It says within 10 years, but a bankruptcy really doesn't have to be 10 years old. Or somebody who has a low credit score, okay? Let's go to the next page. Top of page 170, subprime loans. So a lot of people get confused with the differences. I see the chat. I'll get to you as soon as I get done with the subprime part. So a lot of people, even myself, I'm like, I really don't want to do hard money. I don't really want to do subprime. I don't have the heart to charge somebody 5 points for a loan. I just can't do that. When people were charging 1.5 to 2, I was charging 1 to 1.25. And it was funny, one year my brother said to me, because I work with my family, he goes, if you would have charged what everybody else charges, you would have made an additional $60,000 by now. And it was like August. It was like a little more than halfway through the year. And I'm like, I just can't. So here's the thing. So you go like this, you go prime loans, then you go subprime loans, and then you go hard money. So if a prime loan is 3%, then a subprime loan is going to be closer to 4% or 4.25%. A hard money loan, on the other hand, at the same time, is going to be somewhere around about, I want to say 8.5. I mean, last year I was talking to this borrower and she couldn't prove her income. She had good credit and she had the down payment, but she couldn't prove her income. She wasn't one of my clients. I talked to her this year after she got a loan last year that was a business loan to buy her condo. She's the one that got 9.9%, but that's because she couldn't prove her income. That's a hard money loan. So prime, subprime, hard money. Got it? Okay, I'm gonna look at the chats real quick. See what you guys are asking me. All right, let's see. Is that on the test? If it's coming out of my mouth, it's on your test. How about that? Oh, it's at 937, 500 in January. Yeah, I know. UWM already increased it. You guys are great. Thanks. You guys are awesome. I love when you guys communicate with me. It makes me feel like I'm talking to somebody other than the computer. All right, let's go on. So, I don't know. I guess some people like to do hard money because technically, you guys, if you're doing hard money or non-QM, a lot of those companies only require your real estate license. They don't require your MLO license. Just a thought. All right, going on. Here we go. So I'm on the top of page 70 where it says subprime. We already talked about subprime. Go down to conventional loan LTV classification. So remember that 20% down is the ultimate loan. A conventional loan with 20% down is the perfect loan because it has the least amount of risk, because the borrower is actually putting in 20%. So if they're putting in 20%, you don't have to have mortgage insurance because they have some skin in the game. But people who don't put any money down and have very little closing costs, they don't have any skin in the game. So that's what they're talking about here. 80% conventional loans with 20% down are the safest for banks and lenders to make. So then it has the example of somebody putting 20% down, and it shows you the loan to value of 80%. Now, when you exceed that 80%, guess what happens? You're gonna have to, if you don't have the money to come in with the extra money, you can get a gift from your family or friends. So a gift letter. You can get I said it in class yesterday, and somebody actually called me and said, who's the place that you do those with? The 80-10-10. So if your client has 10% down, they can actually get a loan for 10% and get an 80% first. That's why it's called an 80-10-10. They could also do like a 5% down, 15% second, and an 80% first. So as long as they put at least 5% down, they can get that money from somewhere else. But remember, if they're getting a loan like the 80-10-10, we have to count the payment of the second mortgage, that 10%. We have to count that in their debt ratio, okay? So when the loan to value is too high, it says the ratio is required to be 80%. The buyer can make a larger down payment. Well, if they could and they had the money, they would have put that on their application. The seller can assist the buyer.
With the 10%, how many years is normally that? What kind of a loan?
Oh, it's a 30-year loan.
Oh, it's still.
And it's cute because somebody wrote me a text today. They're like, who does 90%? A lot of people do 90%. Almost everybody does 90%. So it's 10% down, 90% loan to value. You're going to have mortgage insurance on it. And the mortgage insurance, it depends on their credit and depends on the down payment. Because like if they're putting down, like I had somebody that was putting down 13%. I'm like, that's a really odd number. Don't you want to go 15 or 10? And they're like, well, this is what we got and this is what we're working with. But their mortgage insurance really wasn't that bad. And it's interesting because you really want to compare the 80-10-10 with, let's look at their credit score and see exactly what kind of loan amount they're getting. And it might be better to get the mortgage insurance. And I kind of go back and forth with that with my processor because I'm like, well, the guy that I did the 80-10-10 for, he made a lot of money per month. He just didn't have a lot of money saved because he just started working this new job where he was making like $25,000 a month. And I go, okay, so you qualify and everything looks good. If you do the 80-10-10, you can pay extra towards the second, and then you'll have that 80% first. Whereas if you paid mortgage insurance on it, you'd have to refinance it to get rid of the mortgage insurance. And he's like, that's a good thing. And the funny thing is he put 10% on what he purchased was $110,000. So his equity line of credit was $110,000. That's 6%. He's like, where would I get a credit card for 6%? He goes, I could pay that down and then just use it all the time. He could pay that down and then use it for a down payment on another property. Isn't that cool? I know, I just love buying other properties. It's a problem I have. When I bought my last house, I'm like, oh, I think I'm done. So, you just got to figure out what you want to do, right? Anyway, so you can put 10% down and you'll have mortgage insurance. I kind of got away. I kind of got away from you guys, but it's really cool information what you can do to help buyers buy houses. So it says larger down payment they could come in with, or they could have seller give them an 80-10-10. Sellers in this market, especially in California, are most likely not going to do a carryback because they don't have to. They can get cash from somebody else. The buyer can get a gift from family members, or the seller could lower the price. Well, that's not going to happen. Alternatively, the borrower who does not have enough money for the 20% down and still wants a conventional loan can try to get one with 90% down, with 90% loan to value, with 10% down payment. You can even do a 95 conventional loan with 5% down. They say there's 100% financing, but I really haven't seen that. Loans with loan to values higher than 80% are possible with private mortgage insurance. So we talked a lot about private mortgage insurance throughout the course. Some of you were here with me yesterday, and some of you couldn't find me, but I was there on Zoom. I was there Zooming from my living room. But we wanted to make sure that everybody had a good chance to make sure that you guys pass, because that's what we're here for, to help you pass the test. Okay, so they have an example. Where did that, we already did the example. Let's go to where we were, private mortgage insurance. So top of 71. Private mortgage insurance is offered by private companies to insure lenders against default on the loan. Prior to the advent of PMI, lenders would only lend to 80% loan to value. So back in the beginning of time, back when the Great Depression happened, people had to put 50% down. That's a lot. They had to put 50% down, but realize purchase prices of homes were like $3,000. So they had to put down $1,500. And then they had a balloon payment at the end of their payments because they had interest-only payments. So make sure you know that an interest-only payment is a straight note. And I don't know if I told you guys already. I think I told you yesterday. Somebody told me that they just had a question on the test that was a straight note. So and the answer was $1,200 or 12 something, because it was, you have a loan of $120,000. You have to calculate. Let me grab a calculator so we can do it. You had a loan of $120,000 times, let's say it's 4.75% interest. So you multiply it by the interest, and you then divide it by 12. And hold on, what did I do? I did $120,000 times 4.75% interest divided by 12. Yeah, the payment is it right? $475. Is that what you guys got? You want to do it again because you have to know how to do it. You take the loan amount, 120, multiply it by 4.75 interest, divide it by 12, you get a payment of $475. That's a straight note, interest only.
Yeah, 475.
Okay, she said, yeah, 475. If she can do it, you can do it. I can do it. We can do it, right? So that was the kind of question he got. So you have to know how to do that.
And that was the straight note?
That's called a straight note. It's interest only. So I got on that subject because back in the day, you had to get a loan. You had to put 50% down. It was a straight note, meaning it was interest only. So when you got to the end, you still owed half of the loan and you had to have a balloon payment. Well, people were losing houses. So the feds are like, well, how are we going to stop this? We don't want to lose houses. So that's when they started doing longer term loans. But it was FHA that came out with, instead of 50% down, 20% down. And it was FHA that came out with fully amortized loans so you wouldn't have a balloon payment. So that's just a little history on the loan thing. So then they came out with private mortgage insurance. So it says, go to the second paragraph on page 71. When insuring a loan, the mortgage insurance company shares the risk, but only part of the risk. They don't insure the entire loan. They only insure the upper 20 to 25%, okay? In the event of a default, the insurer and the lender will negotiate how best to proceed. For example, the insurer could pay off the loan or allow the lender to foreclose. If the proceeds from the foreclosure action do not fully reimburse the lender for the principal balance, the lender may be able to submit a claim to the private mortgage insurance company. The traditional way that private mortgage insurance companies charge for PMI is with a one-time fee at closing and when the loan is made, and a reoccurring fee monthly. So people who have mortgage insurance have a monthly mortgage insurance fee, okay? And the way that you calculate the monthly mortgage insurance is they'll give you whatever the calculation is. and you'll look on the rate card and multiply it by the loan amount to get the renewal fee. Now, let me tell you a little secret I have. How you like that? So when you're working in the loan business, one of the things I share with the people in understanding the mortgage process is how do you figure out the PMI number? Because you really don't know who it's going to be through. A basic way to do it is I found it. It's the best little tool for free. I love free stuff. It's called Nerd Wallet. And how you find Nerd Wallet is you Google, how do I calculate out my mortgage insurance? And that's what I did because, you guys are going to have to figure this out for people. And sometimes people will just come up to you out of nowhere and they're like, I want to buy a house. What do you think I could qualify for? I make $5,000 a month and I have a car payment of $250. You should be able to take your handy dandy little calculator and figure it out. And you're going to ask them, is there a down payment? Because you might need mortgage insurance. I hate to keep pushing UWM, but I got to tell you, UWM has their own mortgage insurance. And their own mortgage insurance is cheaper because they strongly feel people should be able to buy a home. And when you guys do a loan through UWM, they'll put your name on your client's mortgage coupon. And UWM stands for United Wholesale Mortgage, by the way. And most people are approved through them. They're easy to work with. Just don't take a self-employed borrower there because you'll want to pull your hair out. They don't know how to underwrite self-employed borrowers. So I'm giving you words to the wise, okay? So going on. Y'all good? So the Nerd Wallet will help you. The Nerd Wallet also helps you calculate. So how I did it was I go, how do I calculate mortgage insurance? And then it gave me this little area where you put in the purchase price, you put in the down payment, you put in the loan amount. It'll calculate the loan amount. You put in the interest rate and it will give you the payment and calculate everything for you. Isn't that cool? So if you want to look like you're really smart and you can do it really fast, just go to Nerd Wallet, go, hey, it's this. They're usually I'm usually anywhere from about $10 to $12 off. It's not that big a deal. Okay. So going on to the big I, it says there must be both a borrower default and loss of collateral value at the time of the sale to make a claim for the payment against the PMI insured. If there's no default and a foreclosure sale, but no loss, there's no claim against the PMI company. That's great for the PMI company. Pmi cancellation, we talked about this already. We said PMI equals we put HPA equals PMI, and HPA highlight is Homeowners Protection Act of 1998, requires lenders to automatically cancel PMI when the home has been paid down to 78%. That doesn't mean you got more equity because the value went up. It means you paid it down to 78%, okay? However, but what happens is borrowers, when they know that their equity is up, they go, hey, I shouldn't have PMI. My house is worth way more than what I owe. Well, did you pay it down 20% or did your equity go way up? So the law says if you paid it down by 80%, you can call your lender and ask them to cancel it. However, many lenders have decided that if your equity's there and they verify that the area is not in a declining area, which in California we really don't have that, then they may give you that option to go ahead and get rid of your MI, mainly because they don't want to lose your servicing rights. You have to realize when you leave, what they figure out when they're doing your loan is they figure that they're going to have your loan for 8 to 10 years. The normal mortgage is 8 to 10 years, and then somebody either sells or refinances. I guess I'm not normal. I've had the same loan for like 30 years or longer. I don't know. Anyway. I know it's a 30-year loan. I know I said that. I refinanced somewhere around 20 years ago. So 78%, you pay it down to 78%, they will take your mortgage insurance off. You pay it down to 80%, you can request for them to take it off, but they will make sure that you do not have a second mortgage behind it and that you have not been late, one 30-day late in a year or two 30-day lates in 2 years. Okay, so if you're not, they'll probably take the mortgage insurance off. It says the Homeowner Protection Act has some exemptions, such as multifamily units, non-owner occupied mortgages, and second homes and second mortgages. Most of those don't even have PMI, so of course they're not going to be on there. Next page, alternative financing. Lenders can offer borrowers different financing options that may reduce monthly payments and eliminate PMI, and expand loan program options available, including secondary financing. So we already talked about that, the secondary financing, the 80-10-10. So secondary financing is when the borrower borrows money from another source to pay part of the purchase price or closing costs. The secondary financing strategy that the borrower can use is to highlight eliminate PMI, is to obtain a second mortgage. And then it has an example. You guys can read the example on your own. A second mortgage may also be called a home equity loan or a home equity line of credit. Make sure you understand the differences, because a home equity loan is a closed-end loan, meaning you cannot borrow from it and pay it back. A home equity line of credit is like a big credit card, okay? Secondary financing underwriting. You have to know this stuff. So in underwriting a loan that will have secondary financing, the primary lender, which is your first lien, will include the payment as part of the borrower's monthly housing expense and consider the total amount borrowed when determining, highlight the combined loan to value, the CLTV. The CLTV is the percentage of the property value borrowed through a combination of more than one loan, such as a first mortgage and a second mortgage. The CLTV is calculated by adding all loan amounts and dividing it by the appraised value or purchase price, highlight whichever is lower. For example, the borrower has $10,000 down payment purchase on a property valued at $100,000 with two loans. The first is $80,000 and the second is for $10,000. You add those together and you have 90% CLTV, 80% LTV on the first. For the purpose of private mortgage insurance, however, only the loan to value ratio of the first mortgage is considered. So the borrower with a higher CLTV would not have PMI if the loan to value is 80% or less. Secondary financing conditions. So the first loan is going to make sure that they're able to get out or be refinanced. So they're going to make sure that the second has certain terms and conditions that they agree with. So for conventional loans, the primary lender will often insist on certain conditions with the secondary financing. Although individual lenders may impose additional or different specific conditions, the following are typical examples. The loan to value and CLTV. The first mortgage cannot highlight exceed 80%. Of course, you don't want it to because you don't want PMI. And the CLTV cannot exceed 95%. So you need at least 5% down. Loan terms. The term on the second loan cannot exceed 30 years and cannot be less than highlight 5 years. The interest rate on the second could be a fixed or adjustable, but if the second is adjustable, the first cannot be. You can't have two adjustable rate mortgages. Top of 73. No prepayment penalty. The second mortgage must be able to be paid off in full or in part at any time without penalizing the borrower. Highlight regularly scheduled payments. They don't have to be regularly scheduled every month. They just have to have some type of consistency, maybe monthly, quarterly, semi-annually, some kind of payment. No negative amortization. Highlight ability to qualify. You must make sure that they can make their payment. And subordination clause. So if you don't know what a subordination clause is, a subordination is when you have that second trust deed sitting here and your borrower wants to refinance the first, but they don't want to pay off the second. So when you pay off the first, normally when you pay off the first, the second gets to move into first position. Well, you don't want to do that because you're just wanting to refinance this loan and lower the interest rate. So the subordination says, I'm going to stay in second position while you refinance your first. And you would get the subordination, your escrow company would help you get that through when you're financing them, okay? Seller paid buy down is next. So another option is for the seller to pay discount points or a buy down, and they buy down the interest rate to lower the payment for the buyer. So that would be, of course, in a buyer's market. So if you have very few buyers, and you have a bunch of houses for sale, let's say that your house is for sale and so are 25 others in the same neighborhood and there's only 2 buyers that want to buy in the area and you want to attract that buyer. You may say in your advertisement on your MLO, on your listing, your MLS, all these letters that we have, on your multiple listing service, it may say on there, seller's offering to pay 1 discount point for your interest rate. So if the seller pays a point and it's a discount point, it's supposed to discount or lower the interest rate for the buyer. Now the buyer can also pay discount points to lower their interest rate. So let's look at that. Another option is for the seller to pay discount points to buy down the interest rate for the buyer. Highlight discount points or highlight additional funds paid to the lender at the highlight beginning of the loan to lower the interest rate and monthly payments. Remember that 1 point is simply worth 1% of the loan amount. Paying discount points, also called buy downs, could make it easier for the borrower to qualify for the loan. A buy down can be paid for by either the borrower or the seller. The two main advantages of a buy down is the borrower's monthly payment is lower, and the lender is going to qualify the borrower at the lower interest rate, so they might be able to qualify for more. While buy downs may mean less money to the seller's pocket, it might be necessary to attract a good buyer. So then in the gray box, they have an example of the buy down. You really don't need to have me do that with you. You could do that on your own. And then drop down to a permanent buy down. So there's two types of buy downs, a permanent one and a temporary one. So the permanent one is simple. They pay more points at the beginning to keep the interest rate low for the life of the loan. So highlight points paid, reduce interest, life of the loan. Okay, next page, 74. We're doing good, aren't we? Temporary buy down is when a borrower or third party is prepaying some interest of the loan. So they're not doing it forever, they're just doing it temporarily. So they're just going to pay some of the interest up front. This strategy allows points to be paid to the lender to reduce the interest rate and highlight the payments early in the loan, with the interest rate or payments rising at a predetermined point. When interest rates are high, temporary buy downs are popular means of reducing the borrower payment early in the beginning of the loan. When qualifying the borrower for a temporary buy down, the underwriter will consider the payments using highlight the note rate. So remember, anytime you do some type of loan that's adjustable or a buy down where you're going to step up on the interest rate, they're always going to look at the worst case scenario. What's the highest the payment's going to be, and will the borrower be able to make those payments? Okay. You have to make sure the borrower is always the borrower. It's not about you, it's about them. The note rate stated in the promissory note is the interest rate that will be used to amortize the loan. Since a loan with a temporary buy down has different interest rates, it would be considered a non-traditional loan. Temporary buy down plans can take two forms, a level payment or a graduated payment. A level payment buy down is a plan where the interest rate reduction remains consistent throughout the buy down period. The consistent interest rate keeps the payments the same during the buy down period, as the name implies. For example, the lender may make a 30-year loan at 165 at 9% interest rate, and the seller agrees to buy down the interest rate to 7% for 3 years. So it's a predetermined. So like on an adjustable rate mortgage, you don't know what it's going to do. But on a buy down, you know it's going to do certain things. The graduated payment. The graduated payment is a plan for which the payment highlights subsides in the early years and keeps the payment low.